Yo, what's up guys? It's Josh. Welcome to episode 3 of Stocks and NFTs here on Mcubed, Movies, Money, and Marijuana. Before we start, a short disclaimer. I am not a financial advisor, nor do I claim to be one. Everything said here is for educational and entertainment purposes only. That said, these are my opinions, so feel free to disagree in the comments below and let me know what you think. Today we're going to be talking about what SPACs are. So let's get started. SPACs have been around since the late 90s, but in the last 8 years, SPACs have been used to raise over 200 billion in investors' money. So what are they? SPACs, or Special Purpose Acquisition Companies, are shell companies that have no business or assets but are designed to raise money through an initial public offering or an IPO. This is done by a group of investors or sponsors that form the SPAC. They raise money through an IPO by selling units. These units are typically priced at $10 and are usually made up of one share and a warrant, or a partial warrant. A warrant is a contract that allows investors to buy a certain number of additional shares of a common stock at a certain price sometime in the near future. Because SPACs are traded like stocks, investors can buy or sell shares for the market value after the IPO launch. Afterward, the money raised by the IPO goes into a trust. This trust account typically invests in money market funds or short-term US government securities. The sponsors usually have 18 to 24 months to buy a company that they think shows an upside potential for growth. If an acquisition isn't made, the SPAC is dissolved, and in most cases, investors will be entitled to the amount of total trust from the number of shares that they own. If a business is identified and approved, the SPAC and the business combine into a publicly traded company. This is known as the de-SPAC process. Shareholders can now decide whether to stay invested or to pull their money out. Now, why would a private company want to go public through a SPAC? To put it simply, going public through a SPAC helps bypass some of the regulatory hoops and hazards of a traditional IPO. Some investors prefer SPACs because they give them the ability to get in an early IPO. If the SPAC is successful, the price should appreciate and investors will make money. But of course, there is also the possibility the investment can lose value. Let me give you an example of how all of this would work. The idea is a manager with experience in a particular field or industry will set up a shell company with no assets and no core operations, as mentioned above. This forms a SPAC, and the manager is known as a sponsor. This sponsor will then go around and try to convince public investors to invest in this new company. The manager will promise them if they fund the company, they will go out and find a private firm that will then IPO the SPAC. Since the SPAC has no assets, it's a simple and cheaper process than the traditional IPO route of an established company. From there, the SPAC will approach a private company they want to take public and offer to buy them with the money raised by investors. Sometimes this is supplemented with a loan to said company. If the private company agrees and the investors approve it, they will merge as a SPAC and will take place on the public market. Now, while the sponsor may have had a particular target company when setting up the SPAC, they don't actually have to tell their investors where their money is going. The crazy thing about this is that it's often not disclosed to the investor who they plan on purchasing, since doing so would complicate the IPO process. So in other words, the investor who purchases SPAC shares don't actually know where their money is going to end up in. This is why SPACs are often referred to as blank check companies. Now, what are some real examples that have happened in the past? Some examples of high-profile SPAC companies are DraftKings with ticker symbol DKNG, Nikola NKLA, or Virgin Galactic, SPCE. DraftKings went public via a merger with a SPAC called Diamond League Acquisition Corp. and a gambling tech business called SB Tech Global Limited. They have a fantasy sports app. You might be familiar with Richard Branson. He has the Virgin Brands. His merger was with social capital Heterosophilia, and they formed Virgin Galactic. Nikola Motor Company, a private company that merged with Bechtel IQ Acquisition Corp. Back in June of 2020. They are a manufacturer of hydrogen electric trucks. Well, supposedly. And I say this because of the whole Nikola fiasco. That's a whole topic for a different video. SPACs have been around for decades, and in the past they have had a bad reputation for scamming investors. However, the SEC started regulating SPACs in an attempt to reduce this fraud. The regulation grants investors the right to redeem units before an acquisition. So how does an investor determine whether to invest in a SPAC or not? In my opinion, with these three questions: who is the management team? Is it a good investment? And what are the opportunity costs? First, the management team, because when you first invest into a SPAC, there is no company to start with. There is no assets, products, or track record. Many investors rely on the management team to make the SPAC successful. Some famous high-profile sponsors include Chad Palihapitiya, a former Facebook executive, or Bill Ackman, a famous hedge fund manager. Sponsors are paid for the success of the SPAC through the share ownership called the promote. The promote allows sponsors to buy 20% of outstanding shares at a discounted price. Secondly, is it a good investment? The SPAC will provide shareholders with an official statement about the proposed merger, including financial statements or any corporate matters. One benefit of the traditional IPO route is companies and management teams go under audits from investors, regulators, and underwriters, or simply an investment bank that acts as a broker between the issuing company and the investment public. Finally, what are the opportunity costs? Investors must always weigh the risk and determine how a SPAC fits into their overall portfolio strategy. This will always vary, and it's different for every type of investor. Now, why are SPACs gaining so much popularity? According to Dr. David Patton, managing partner of Navigation Capital Partners, who have partnered with the New York Stock Exchange, have created a standard of templates for a quicker and easier, more efficient SPAC process. He summarizes this in 3 points: supply and demand, private and equity markets, and SEC regulation. 1. Supply and demand. The number of public companies has gone down dramatically over the last 20 to 30 years, dropping from 8,000 to just 4,000 today. But the amount of money flowing into the public markets has simultaneously been increasing because the stock exchange makes their money by bringing on new companies. They've pushed to bring more SPACs into the market. 2. The private equity market. There has been a huge increase in the amount of capital invested in private equity, over $2 trillion today, but the number of exits has seen a decline. Private equity-backed portfolios are always looking for opportunities to exit and make a return, so they are supportive of the SPAC model. 3. SEC regulations. The SEC has become more involved in regulating SPACs, which has proven to boost their reputation in the investment world. They have stepped into a set fixed price for each IPO, as well as regulating voting and redemption rights to the benefit of all parties involved. Again, all this is according to Dr. David Patton. Well, I hope this video helped you understand what SPACs are. Please leave a like and comment down below and let us know what topics you'd like to hear us talk about. Again, my name is Joshua Ramirez. This is the Mcubed channel, movies, money, and marijuana. Stay tuned for next week's episode.